Welcome to a Kong Lim and Partners production of the Singapore tax treatment arising from the adoption of FRS115. In this episode, we are going to explain the exceptions to accepting accounting revenue for Singapore tax purposes. As mentioned in our previous episode, the new revenue recognition accounting standard is relevant for tax purposes as the accounting revenue constitutes for the revenue that would eventually be subjected to tax. There are a few exceptions to the general tax treatment where IRAS will not accept the accounting revenue as the revenue for tax purposes. Namely, where specific tax treatment has already been established through case law or provided under the law, and where the accounting treatment deviates significantly from tax principles in the case of contracts with significant financing components. For example, in the case of property development, the profit or revenue of the property developers is recognized for tax purposes when a project is substantially completed, in other words, when the temporary occupation permit is granted. This is regardless of the revenue recognition method adopted for accounting purposes under current accounting standards. This existing treatment for property developers will remain the same despite the new FRS 115. When determining the transaction price under FRS 115, one should consider whether the promised amount of consideration provides the customer with a significant benefit of financing the transfer of goods or services to the customer. For example, if the goods are to be delivered today, but the customer is only required to make payment in 2 years, that creates a significant financing component to the agreement. Under certain circumstances, an entity is required to present the effect of financing separately from the revenue from contracts with customers. Such interest revenue and expenses are estimated adjustments and should be disregarded for tax purposes. Therefore, tax adjustments need to be made to subject the correct amount of revenue to tax as income in the year it is earned. Similarly, estimated interest income is an accounting construct and should not be brought to tax. The necessary tax adjustments would have to be made in the tax computation to bring the correct amount of revenue to tax as income. Information relating to adjustments from significant financing components should be clearly disclosed in the tax computation. In our next episode, we will be covering transitional tax adjustments.